Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. Hope you're really well. Hope you had a really fantastic week and everything is all good with you. Now, we finished last week on a bit of a cliffhanger. We'd had the inflation news that had come out. Inflation had come down by over 1%. Core inflation had kind of stuck where it was the previous month, so no changes there. And we're waiting to see how the money markets were going to react to that in terms of swap rates and how this would impact fixed rate pricing in the mortgage market. So we're going to be updating you on that, don't you worry. We're also going to be talking about more broadly lender pricing, what's been happening, changes in lending criteria. We're going to talk about the latest news on house prices and what's happened in the last month. And then finally, we're going to be talking a bit about whether landlords are actually really selling up and leaving the buy-to-let market. Okay, so last week the inflation news came through that inflation had dropped by just over 1% and core inflation had stayed static. This was in the kind of aftermath of news about wage inflation and GDP. So GDP had performed better than expected, wage inflation was at a record high. And so it was interesting to kind of watch the money markets and how they reacted to these bits of news essentially all bound up together. And unfortunately, it wasn't great in terms of fixed rates. We saw swap rates actually increase after the inflation news. So what we had been hoping is that the inflation news would come out, great news that inflation had come down, markets would be calmed, and therefore fixed rate pricing could start to kind of ease down. Sadly, not the case. Swap rates actually have increased. And so it's been quite interesting to see how the lenders have reacted. So in terms of the numbers that sit behind this, so 2-year swap rates as of, today's actually Tuesday, so it's about 2 in the afternoon. So midday on Tuesday, 2-year swaps were at 5.653. 1 month ago, they were at 5.495, so they've increased by circa 0.2%. 5-year fixed, 5.008, 1 month ago, 4.718, so increased by just over 30 basis points. So I think really now, all there is to do is watch and wait and see what the inflation news brings us next month. We're going to have the base rate news announcement in September, very much an expectation that base rate's going to be increasing again by 0.25%. So let's wait and see how that kind of lands, and then hopefully we might see swap rates start to ease down. But as we all know, swap rates are how lenders essentially base their pricing, broadly speaking, on fixed rate mortgages. So it all kind of trickles through to essentially you guys, hence the reason it's really important. Now, interestingly, despite the fact that swap rates have been ticking up, actually in the last week, what we've broadly seen, with a few exceptions, is lenders pricing downwards. Now, I think this is probably a timing thing more than anything else. So the lenders will have been, in advance of the inflation news, GDP and wage growth and the swap rates going up, will have been busy putting together a set of product pricings. These things don't always happen overnight. They can take quite some time for some lenders to pull together. So I think what we're seeing is some lenders' rates have come down because they simply were in advance of all the news that came out last week. And also some lenders are probably just taking the view that actually it's a really quiet time of year, more so than normally in the summer. So actually what can we do to try and drive up some new business volumes? I know we'll take a sort of haircut on our margins. So with this in mind, we have seen Aldermore reprice. They've dropped their pricing down a bit, so they've now got 5-year fixed rates from 5.69% available to 75% loan to value, 5% arrangement fees on their lower rates. And obviously, as with most lenders these days, lower rates, higher fees, and then they work their way up till you get to the point where you've got, a reasonably high rate, but with no arrangement fee at all. Now, Aldermore as a lender, they are specialists, they are wonderful. They have a couple of niche things in their product set. So first of all, no maximum number of properties in the background, no minimum income requirement. They can lend to trading limited companies, so companies whose sole activity is not simply renting out property. You could be a company that is a dentist and a landlord, or one of the million other connotations you can find of that. Or also, actually, they can do layered companies, HMOs, multi-units, and they do their multiple property application. And we talked about this last week. So one mortgage secured against multiple properties. So great to see those guys bring their pricing down. Now, we've also seen the leads reduce their rates by up to 0.16% for limited companies. So their limited company rates are now from 5.99% with a flat arrangement fee starting from £4,999. Leads are a new player in the limited company space. We shared their launch with you a few weeks ago. You know, really good offering, very, very solid. I put it into the kind of same bracket as the Mortgage Works. So very, very straightforward company structures. The properties can't be at all even slightly racy, but actually if you fit with those sort of very kind of strong parameters, which lots of landlords would do or limited companies would do, then this could be a really good option for you. Hampshire Trust, now these guys are an interesting one. So they've reduced pricing on some of their products by up to 0.7%. Now Hampshire Trust are, as far as sort of specialist lenders go, they're kind of very much at the specialist end of being a specialist lender. So these guys can do things like non-UK nationals, not living in the UK, expats, they do Airbnb, they can do complex ownership structures, they can consider sort of some levels of adverse credit, they can have really large HMOs, really large multi-units. They can also do semi-commercial properties, so a property which is partly commercial and partly residential as well. So the standard thing you think of here is a shop with a flat above, as an example. So really, really good lender, and great to see their pricing come down. We've also seen Paragon tweak their limited edition 5-year fixed rate. So last week they made some reductions to their 2-year fixed rate limited edition products. This week the 5-year rates have come down slightly, so these are now from 5.35%, 5% arrangement fee. And then lastly, Landbay have released some semi-exclusive products. Semi-exclusive is where a lender releases a series of products which isn't available to all brokers or direct to the borrower if they're a direct-to-borrower institution, as well as via intermediaries. And so not everybody has access to them. Thankfully, we are one of these people who've been chosen to receive this. Thank you very much, Landbay. So on these semi-exclusive products, the rates here are from 5.55% on 5-year fixes. Again, the standard stuff from specialist lenders, HMOs, multi-units, limited companies, that kind of thing. Now, in terms of rate increases, we have seen a couple. So we've seen West One increase some of their 5-year fixed rates by up to 0.2%. Conversely, they have made some reductions to their 2-year fixed rates and trackers. These are now starting from 5.39%. And Landbay, who have just released their nice semi-exclusive products, have also made increases to their core range, so the range that's basically available to everybody, and increased their rates by 0.3%. So a bit of a mixed bag this week. I think probably the direction of travel in terms of pricing over the next couple of weeks is going to be upwards, just because then the cost of funds have increased, and so that has to pass it on to the borrower, unfortunately. But maybe, just maybe, because it's relatively quiet at the moment, the lender's ability to or desire to lend money and therefore maybe make some reductions on margins may help to counter some of those increased costs. But we'll update you as always next week on that. Now, in terms of lending criteria changes, we have seen Hampshire Trust make some fairly chunky changes to their lending policy. Now, just thinking back a few moments ago, I was talking about them as a lender, how very specialist they are, and you're going to kind of really see that kind of feed through in terms of the changes they've made to criteria. So the first thing is they have removed restrictions on the maximum number of units any borrower can have with Hampshire Trust Bank and the maximum loan amount, so individually per unit. Now, what this does actually not do is, so they have a maximum exposure to one borrower across all borrowing across multiple units of £25 million, but they've removed the maximum lending per unit from their lending criteria. Now, another thing that they've done, which is very, very interesting, is they are now accepting cases where properties are let to third parties for emergency housing, rehabilitation or social transitional purposes, provided there is a credible professional operator providing appropriate management. So they said that we're now able to accept vulnerable tenants and offer additional support for landlords with wider property portfolios. Now, this is important because we are seeing a definite turn in the number of people who are looking to let their properties on essentially leases. So a 5-year agreement is kind of the normal one, to a third party who will then use the property to be to house people who could be classed as vulnerable. Now, most lenders dislike lending with their vulnerable tenants in place because, I think it would be great for a lender if they had to repossess the property and sell it on and thus make a bunch of, vulnerable people homeless. Isn't anything that anyone would feel particularly good about. But there are lenders who are prepared to do this. So actually what we have found is in the past, if someone's come to us and they're looking to use, for example, Serco would be the kind of company that springs to mind as a tenant, a lot of lenders will say no. Now, there are already some lenders who can deal with this, but it's great to see that Hampshire Trust have recognised that this is a kind of area in the market which is pretty unsupported and decided to kind of open their doors to that. Now, just as a kind of an aside, why landlords like these kinds of arrangements? Well, the first thing is that it's a very kind of safe option for you. So you hand your property over for 5 years, you're guaranteed to receive the rent, you don't have to get involved in the running of the property, and actually the lease that you would have would be repairing and insuring. So that means that actually when you receive the property back in 5 years or whether that might be, it has to be handed back to you in the condition which you gave it to them initially. So it means that your property is looked after as well. So guaranteed rent and guaranteed kind of looking after of your property makes for happy landlords, I think. And so I think some people are now kind of really turning to these kinds of options as a potential strategy for their buy-to-lets. And the last thing that Hampshire Trust have done is increase the maximum amount you would need to be borrowing with them using a limited company for the debenture requirement. So they're now saying that unless you have more than £2 million worth of borrowing with them, they're not going to require a debenture, which is essentially a legal charge over the limited company which they're lending to. A lot of people dislike debentures on limited companies because it can kind of cause you issues if you want to borrow with a different provider in the future. Also, it means that that the lender can have the ability to ask for information on the company, see the accounts, make sure it's operating okay. So there's a kind of level of kind of overseeing from the lender, and some people really dislike that. So actually, not having a debenture in place is something that generally people find to be preferable. We used to see a lot more of people or lenders wanting debentures kind of before limited company lending became quite so commonplace. A lot of lenders who were asking for these originally have said actually we just don't want them anymore, and now Hampshire Trust is saying, look, unless you kind of breach £2 million worth of debt with us, we're not going to ask for that debenture. House prices now. So look, the average asking price of a property coming to market, this is not how much they're selling for, this is how much people are asking for them, fell by 1.9% to £895 this month, which is the sharpest drop in asking prices at this time of year since 2018. This is according to Rightmove. Now they say that this year's drop was noticeably larger than the usual price falls from August, which is an average drop of 0.9% due to traditional summer market slowdown. So a much larger slowdown than we normally experience at this time of year. Now Rightmove have kind of taken this data and interpreted it to mean that it indicates that some sellers are heeding their agents' advice to price competitively in order to attract a buyer against the backdrop of holidays, cost of living pressures and the highest Bank of England base rate since 2008. Asking prices are now 2% or £8,000 lower than at their peak in May. However, this is still 19% or £59,000 higher than in August 2019, highlighting the significant price growth over the past 4 years. Now they go on to say that buyer affordability is not only helped by sellers' lower asking prices, but also by a downward trend in mortgage rates. The average 5-year fixed rate mortgage is now 5.81%, down from 6.08% just 3 weeks ago, which is showing tentative signs of further improvement. So I think what we're essentially saying here is that when the interest rates are really high and the house prices are really high, buyers essentially just, or first time buyers particularly, couldn't actually afford to buy. But now we're seeing house prices soften, the mortgage rates coming down from where they were, particularly in the autumn of last year. Actually, things are starting to kind of come together. Also, everyone's getting a pay rise at the moment, aren't they? Which is not really helping us, but in some ways it is. So that's really kind of bringing numbers together, which means that some buyers are able to be back in the market looking to acquire things. So where does this mean we are in terms of the house price slowdown? Are we near the bottom? I get the sense we probably are. I do think that the numbers that we're seeing in terms of people registering as new potential buyers, inquiries on properties for sale, how kind of busy the market is, that's starting to really gain momentum again. The number of mortgage approvals is increasing. So signs that people are starting to come back to the market after kind of summer of watching and waiting. But let's just watch this space. Now, I don't like this article that I'm going to share with you, but I am going to share it nonetheless. It just makes me really sad. So new research has come to a conclusion that will surprise very few, that landlords today are twice as likely to be selling as they are buying. Findings published by research consultancy BVA-BDRC and a study commissioned by the National Residential Landlords Association show that in Q2 2023, some 12% of landlords in England and Wales sold properties. In contrast, only 5 purchased. The research also found that 37% of landlords plan to reduce their portfolios in the coming year, and this is the highest proportion ever recorded. Just 8% say they plan to increase the number of properties that they let. And what the article went on to say is that all of this is despite the ever-growing demand. So 67% of landlords in the study also report the tenant demand has increased in the second quarter of this year, another all-time high. Now, the NRLA are actually kind of using this data to help essentially back up their call on the government to scrap the Section 24 tax changes, because this is what they believe is the thing which is really putting landlords off being in the market. So I do wish the NRLA well with those endeavours. I'm not entirely convinced they're going to be successful, but I still would wish them all luck, and obviously it would be great if they were. But I think more importantly, what we're seeing here is a kind of a number of landlords who are exiting the market now. Now, what's interesting is that actually as a business, we're not seeing this when we're talking to our clients. Now, I guess you could argue that the fact they're phoning us for a mortgage shows that they're kind of in the market and looking to raise money, and therefore that wouldn't be the kind of phone call we'd be having. But even those landlords who have got larger portfolios, most of them aren't selling anything. What they do seem to recognise is this is just a moment in time. Rents are increasing, tenant demand is increasing, void periods have come down. Yes, financing costs are increasing, but lots of landlords are on fixed rates, which they fixed maybe 2 or 3 years ago, even just a year ago, which are much lower they can get now. So actually, for these guys, everything that's going on in terms of the interest rates is kind of just background noise to them. And hopefully by the time they come off those fixed rates deals, things will have come back down again. Now, not to where they were previously, of course not, but come down to a more manageable level. So I think really our clients, what they're saying is, look, I don't like it at the moment, it feels pretty uncomfortable, but it is just a moment in time. It can't always be good. No business is always good. So I'm just going to kind of sit tight and ride this out and actually potentially look to capitalise on the house price reductions and therefore the greater yields that places are now receiving over the next few months. And that's everything I've got for you this week. Thank you so much for joining us. I do hope you found that helpful. If not, it was slightly depressing. Hopefully we're back with better news next week. I seem to say that every single week at the moment. But as always, if you have any questions, you're so welcome to give us a call 0345 345 6788, or have a little toodle around on our website where you're going to find lots of great information. Have a really fantastic, it's a bank holiday, isn't it? Actually, yes, bank holiday weekend. I hope you have a lovely time. I hope the weather's kind. I'm not here next week. I'm actually on holiday for all of next week. I'm going on a cruise to Norway where it's forecast to be raining for the whole week. So that's good. So look forward to me whinging about my holiday next time I'm back in 2 weeks' time. Until then, look after yourselves and I'll see you in a couple of weeks.